Hello, fellow Rebel Capitals. Hope you're well. So, breaking news, bank stocks are crashing once again. It's a result of a downgrade or a possible downgrade from the Fitch rating agency. Let's get right into this CNBC article and think through what's actually happening, connect some dots, because this could have some huge systemic risks that aren't obvious when you just first read through the article. So let's get into this here. CNBC, Fitch warns it may be forced to downgrade dozens of banks, over 70 altogether, including JP Morgan. So if you were thinking, oh, well, this is just something that might be applicable to the regionals or community banks, George, this is old news. No. This includes the big banks as well. Key talking points. Fitch ratings cut assessment of the banking industry's health in June, a move that analyst Chris Wolf said went largely unnoticed because it didn't trigger downgrades on banks. But what they're saying now is Fitch is saying, although we're not downgrading them today, there's a high probability that we're going to be downgrading them in the near future. And if you are thinking, well, okay, George, what's the big deal? That's probably already priced into the market. No. You're not understanding that if they downgrade the big banks, they're going to be downgrading all of the banks, and that's going to move a big portion of them from investment grade down into not investment grade. And that could be a black swan that nobody is thinking about. We're going to go into that in just a moment here, but let's continue down through these talking points. But another one-notch downgrade of the industry score from AA- to A+ would force Fitch to reevaluate ratings on each of the more than 70 U.S. banks it covers. Quote, if we were to move it to A+, then it would recalibrate all of our financial measures and would probably translate to negative rating. So what they're really talking about here is the entire sector, not just specific banks. Again, the entire sector downgrading. So let's get to the punchline. It comes in this pictograph right here. Fitch ratings assessment of U.S. banks. At the top, AA-, A+, A-. Here's where it gets interesting. This light blue, notice, BBB, and then the gray right below it, BBB-. Why is that important? Because this is the bottom of the tier, the bottom of the category that would be considered, quote unquote, investment grade. Once you go from BBB- to BBB+, now all of a sudden you're in the yellow, which should be red. You're in the no bueno zone, as I say on the whiteboard videos. And this is massive. Why? Because so many pension funds and large pools of money in the United States can only invest in investment grade debt. So let's just assume for a moment. And so what they're saying is right now our top tier, what Fitch is saying, right now our top tier is AA-, but we have to move that down to A+. And if so, basically all these banks that you see just move down a notch. But I'm sure there's a lot that would apply, that this would apply to, that aren't listed here. Right now, right on the cusp, we've got Bank United Inc., East West Bank Corp., First National of Nebraska, Synovus, if I'm pronouncing that right, Financial Corp., Trustmark, and Western Alliance. Okay, so let's just assume for a moment, right now they are borrowing at, their bonds are trading at, let's just say 5%. And so if they need to borrow for their corporation, for their bank, this isn't really including depositors, but if they need to borrow money to run their business, they issue bonds. Okay, they're doing that at 5%. If they go down to BBB+, BB+, then they're no longer investment grade. The interest is going to skyrocket, meaning the price of those bonds is going to absolutely plummet because all of those big pools of money that hold their debt right now, they're going to be forced by law to sell. So it takes out your biggest buyer. So it takes out the biggest buyer, inverse relationship between price and interest rate. That means price goes down, interest rate skyrockets. So all of these banks would have to refinance at, let's say, 10%. And I'm just using that as a hypothetical, instead of, let's say, 5%. Okay, well, how does that play out? Does that, especially when they're seeing deposit flight and they're having to pay more for their deposits and their net interest margin is decreasing? So what I mean by that is they're having to pay short term for money, let's say, at, let's say, 4.5%. They're able to lend at 6%. Okay, well, 6 months ago, they could borrow a deposit. They could pay depositors 50 basis points. So now all of a sudden they go from having to pay 50 basis points to depositors to, let's say, 4%, just to make sure that they don't have deposit flight and they turn to the next Silicon Valley Bank. But yet what they can lend out at remains the same. So their net interest margin, effectively their profit margin, has shrunk to almost nothing. While at the same time, on the expense side of the P&L, they may be having to double the amount of interest rate they pay to borrow from the market, to issue bonds. So this is a huge, huge problem, right? And again, I want to be clear, Fitch has not downgraded them as of yet, but here's this industry pro, last name Wolf. I think his name was Chris Wolf, if I'm not mistaken. But this is paraphrasing his opinion. Say this time, Fitch is intent on signaling to the market that bank downgrades, while not a foregone conclusion, are a real risk. This is something that we have got to pay attention to. And the market is definitely paying attention to it, because if you look at the price of like an ETF that looks at the regionals or the banks that would be in this category of going from investment grade to below investment grade, those share prices are plummeting right now. Now, they're not down 10, 15%, but they're down significantly, indicating that the market sees this as a real risk. And let's not forget, the curve is inverted. Once that curve steepens out, if that happens as the Fed dropping rates due to some sort of crisis, due to the unemployment rate going up, well, what is that going to do to Fitch's outlook on the overall economy? And if their outlook sours on the overall economy, what is their outlook going to do for these banks that they're already saying are in jeopardy of getting downgraded? Then it's just going to continue to increase the probability that that happens, and therefore you have this domino effect. All right, guys, crazy stuff continuing in the banking system. As we have said on this channel for a long time, I think we're only in inning 5 or 6. Definitely haven't got to inning 8 or 9 yet. That'll probably play out maybe in the next 6-9 months. So definitely have to follow this story. All right, guys, enjoy the rest of your afternoon. As always, make sure that you're standing up for freedom, liberty, free market capitalism. See you in the next video.